Good morning and welcome to the Killik and Co market update. It's been a pretty exciting week with some unexpectedly big moves in markets, especially in the US and Japan. So let's take a look at what happened and why, starting with the US. Last Friday, we had the publication of the latest non-farm payrolls data, which shows how many new jobs were created in the US during the month. Farm jobs are excluded because they're very seasonal. More job creation suggests a stronger economy. However, last week's number was quite a way below expectations, and this sparked concern that the Federal Reserve has been too slow to start cutting interest rates. Expectations of a near-term rate cut suddenly ramped up. Investors tend to buy bonds when they expect interest rates to fall, which pushes up the bond prices and pushes down the yields. Look at the drop in the 2-year Treasury yield last week, down from over 4.5% to less than 4% in the space of a week. To add to the uncertainty, Kamala Harris has moved ahead of Donald Trump in the US election polls. Markets don't like uncertain situations. A couple of months ago, a Trump victory looked to be a near certainty, but now the election looks as though it could go either way, and it's all dependent on a couple of important swing states. We then saw a surge in the VIX index, also known as the Fear Index, which shows expected future volatility. Here it is over the last 5 years. The last big surge was in lockdown, but look at that rise in the last week. All of these things combined to cause a sell-off in US equities. Here are the S&P and the Nasdaq Composite in percentage terms over the last 5 years. The Nasdaq moved into correction territory this week, meaning it dropped 20% from its record high. However, the panic did seem to be quite short-lived. On Thursday this week, we had some more job market data from the US, showing that unemployment claims were lower than expected. That was good news, and it caused the market to bounce back. In fact, this week we've had the S&P 500's best and worst days since 2022. We saw some much more extreme moves in the Japanese markets this week. We briefly talked about Japanese markets in the video last week, but this week's moves have been much bigger. Here's the Nikkei 225. It dropped 12.4% on Monday, and then it gained 10.2% the next day. This chart shows it over 3 years, and this one shows it over the last month, just so you can see the drop in a bit more detail. The main reason was concern over the unwinding of the so-called yen carry trade, which is when people borrow in a market with a low interest rate and they reinvest into a market with a higher one. This chart shows US and Japanese rates over the last 20 years, the US in the pink and Japan in the green. The Japanese rate has been below zero for much of the last decade, while the US rate has recently been above 5%. The big difference between the two makes these carry trades attractive. Now that Japanese rates are on the way up and US rates are expected to fall, the carry trade becomes less attractive and a lot of these positions are being unwound. Some of the money borrowed in Japan was invested in the US, and a lot of that money was withdrawn this week, contributing to the US sell-off. The increase in the Japanese rate has led to a strengthening in the yen. We looked at this last week, but it strengthened even further since then. It rose 13% between July and August. A stronger yen will make Japanese exports seem more expensive, cutting demand, and fears about that led to the drop in the Nikkei. There was a sense that Monday's fall in the market was overdone, and therefore we saw lots of buyers coming in the next day, which pushed the market back up. However, the Japanese central bank is going to have to tread very carefully as it goes ahead with further interest rate rises. And finally, we're coming to the end of quarterly reporting season, and one trend that has stuck out is a decline in the demand for travel. In the years following COVID and lockdown, we saw this huge spike in demand for travel and experiences, and that led to a resulting spike in airfares and other travel costs. However, the most recent results from travel companies do suggest this demand is starting to moderate. Shares in Airbnb, Marriott, and Disney all weakened after their latest results, with Disney saying its parks business had slowed down. All 3 shares have underperformed the S&P 500 over the last year, as you can see here. The S&P 500 is shown by the black dashed line. We'll have to wait and see if falling interest rates result in more disposable income and therefore a rise in demand for travel. Moving on to have a look at next week, we're coming to the end of reporting season, but we are expecting results out from Aeon, Orsted, and Adyen. That's it from us. Have a great weekend, and we'll see you next Friday.